Hello, good afternoon. Oh, hello, good evening.
Good evening, sir.
Please, can you mute Sonia? Abiodun, please mute your speaker. Once you get to the classroom, please ensure your speaker is muted. All right, thank you. Promise child. Good evening, all.
Good evening, sir.
All right, we go to the business tonight. The business is strategic financial management. The aspect we are looking at is capital structure and theories of gearing. We started this topic last week. Let's do a recap of our last class. What is capital structure? Why are we interested in companies' capital structure? The capital structure is the financial structure of a business. It shows the different types of capital a company uses to finance its activities. Capital structure shows the mix of equity and debt capital a company uses to finance its business activities. Now, why are we interested in the choice of capital structure? You can choose to finance your business with your personal money. That is equity. Or you can finance your business with your equity and borrow money to support your business. You can finance your business with a combination of equity and borrowed fund. Now the question is, why should we pay attention to how company is being financed? Your choice of capital structure will affect your cost of capital. It can either increase your cost of capital or reduce your cost of capital. A company choice of capital structure can either increase the company's cost of capital. If your cost of capital is increased, that means your expenses is increased. And reasonably, business organization wants to minimize their expenses. If you don't know how to combine your capital, that can increase your cost of capital. If your cost of capital increases, that can reduce your profits. If your profit reduces, that will affect returns to the investors. That means the value of the company can reduce. This is the more reason why companies pay attention to the choice of capital structure. And that is why as finance managers, we must understand the concept of capital structure. We discussed this last week. We look at the factors that determines company's capital structure. We discuss risk, business risk, financial risk. We explain the meaning of leverage, that is gearing, the extent to which a business is funded with borrowed funds, the proportion of debt capital in the company's capital structure. That is your gearing ratio. We explained that there are two types of gearing: financial gearing and operating gearing. Your financial gearing shows relationship between debt capital and equity capital. It shows the extent to which a business is funded by borrowed funds. And we explained that financial gearing is used to measure financial risk. We equally explained how to calculate financial gearing. We discussed operating gearing. Operating gearing is used to measure your level of business risk. We now look at theories of capital structure. What are these theories? We have the traditional theory of capital structure. And we have Bodigliani and Miller theory. This theory explains the impact of capital structure on companies' market value. That was the discussion last week. Tonight, we shall be looking at questions from last diet, May diet question. This question has been shared with the group chats. The question is not in your study pack. The ICAN question last diet has been shared with the group chats. Now refer to this question. Let us look at question number 4. All right, this is the question here. This is question number 4, last diet. I will read. Sun Steel, Nigerian PSC, is a long-established company engaged in the manufacturing and distribution of buildings and roofing materials. The company is listed on the Nigerian Exchange Group and has developed a reputation for reliable dividend payments and prudent financial management. Sun Steel owns extensive tangible fixed assets, including modern production plants in Ogun and Delta states, and a nationwide network of warehouses and distribution vehicles. These assets have been largely insured and they are unencumbered. The company currently has the following capital structure: ordinary shares, 8 billion naira, retained earnings, 2 billion naira, 10% debentures, 5 billion naira. If you look at the capital structure, this company is financed by ordinary share, equity shares, equity capital, and debt capital. That means this company is a geared company. It's financed by a combination of equity capital and debt capital. Your debentures is a debt. Please, can you mute, sir?
No, I'm not talking. No.
Please, when you get to the classroom, just help us check your speaker. This structure has remained unchanged for 5 years, resulting in debt to equity ratio of approximately 45%. That means currently the gearing ratio is 45%. The level of gearing is currently 45%. The next paragraph. The finance director believes that Sun Steel can take additional borrowing to fund its future expansion, arguing that the gearing is comfortable. However, the board wishes to review the factors that should be considered in determining appropriate capital structure before making any policy changes, requirements. As the company's financial advisor. That means you are the company's financial advisor. The students are the advisor now. Discuss the main practical factors that should be taken into account when determining or reviewing the company's capital structure. Using Sunsteel PSC as an example. This question was texted for 20 marks. The question is very direct. What are the factors that determines company's capital structure? You are not going to discuss it using Sunsteel. You are going to look at Sunsteel peculiarity. You are going to look at the company's circumstances now. Let me hear from the students. What are the factors you are going to consider if you are to review this company's capital structure? The line is open. Let's get contribution from the students. Yes. Abiodun. What are the factors that determines company's capital structure? The class is silent. Possibilities. Please hold on, Tosin. Let us hear possibility.
Okay, good evening, sir.
Yes, sir. I love this. Possibility. It's possible.
Yes, sir. So, some of the factors that determine companies' capital structure includes one, earning stability.
Any stability,
And
correct.
from this question, yes, sir. And from this question, we are told that Sunsteel, they have maintained and they have reputation of paying consistent dividend over the years. So
Correct.
therefore,
Number one
they
factor, any stability. In the question, examiner says this company maintains. Please hold on. The network is. Let me take that again. Number one is any stability. If you go through the question, examiner says this company maintains a reliable. That means the company have earnings. We are going to look at earning stability. Thank you. Yes, Oluwatosin.
Hello, sir. So we look at
Yes,
growth, their future growth.
future growth potentials or opportunities. Company is planning expansion in the future. So we are going to look at the company's growth potential. Somebody also raised up his hand. Alright, is good. Yes. Toluwani. Yes,
Good
you are
evening,
in
sir.
peace.
Good evening, sir.
Yes, you are welcome, man.
Yes, sir. We'll look at the asset structure, that is assets backing, and from the question, some still has tangible fixed assets, that's plants in Ogun and Delta states with
Oh,
warehouse.
that's brilliant.
Yeah,
That's
so
brilliant.
their assets will more like give the borrowers, give the lenders something more like something to hold on.
Collateral.
Yes, collateral, like that.
Oh, that's brilliant. She said, we are going to look at the company's asset structure. From what we read in the question, examiner said this company has extensive fixed assets, such as plants, warehouses, vehicles. These assets can be used as collateral to obtain additional borrowing at a very good rate. Yes, Dekule, you raise up your hand.
Yeah. Good evening, sir.
Yes, sir.
We should also consider the business risk
Yeah, we look at the business risk.
because if we consider any business expansion, we need to look out for factors that may affect the normal business operation in sense of either losses incurred or profits we might ascertain from the expansion.
All right, I think I agree with you. We are going to look at the company's business risk. Risk that has to do with the nature of your business. This company is into building materials and roofing sheets. Building material business is a business that has a steady demand. Even in rough time, people still buy building materials. So the nature of the business will have impacts on the company's capital structure. Your nature of business will give rise to your business risk. Okay, one more. Toluwani.
Yes, sir. The cash flow position of the company. At the moment, it's still a debt to equity ratio, but I feel as if they need to look at the operating cash flow if it's comfortable for them to either pay the interest or the capital and repayment comfortably without affecting the
That's
business.
brilliant. That's brilliant. Thank you all. We need to look at the liquidity position of the business. We need to consider the liquidity position. Now let's go to the solution. Let's go to this. As financial advisor, here are the main practical factors the board should consider. 1, business risk and stability of earnings. Sun Steel has stable earnings, in brackets, reliable dividends, established business, essential products. By implication, the company can undo more debt. The company can borrow more debt, as suggested by the finance director. Because building industry, building materials demand is steady, even in rough time. However, we need to look at the risk. Construction sector downtimes can affect volume. During rainy season, most construction companies might not do much. During this period, that can affect sales of building materials. So we need to look at the business risk. That is one. Number two, asset structure. Now, when you are discussing, you are going to relate it to the company in question. Sun Steel, extensive, unencumbered assets, such as plants, warehouses, vehicles. By implication, the company can secure more borrowings using this asset as collateral at good rates. Actions. We advise the company to leverage. Company should leverage this. That is, Sun Steel should leverage on its assets to borrow money to finance the expansion. Leverage this for expansion loans before issuing equity. Number three reason, cost of capital and tax shield. Generally, debt capital is cheaper compared to equity capital because of the tax benefits. Because of the tax benefits, the company can take advantage of debt finance to fund the expansion. However, the company must also realize that by bringing in debt finance, that will increase level of financial gearing. By bringing in more debt finance, that will increase the financial risk. The company may need to consider and compare cost of new debt versus dilution in equity. What is the cost of obtaining new debt compared to diluting the equity? That's number three factor. Number four factors, financial flexibility and future need. Yes, the company plans expansion. Sun Steel plans expansion. That means the company requires funds fast. If you are planning to expand your business, it means you require money fast. Currently, the debt capacity looks good. The level of debt, 5 billion. Total equity fund, 10 billion. The level of debt capacity, it still looks good. But the company must avoid over-gearing. The company must avoid excessive borrowing. Why? The company needs to retain ability to borrow for emergencies. What we are saying is Sunsteel should not exhaust its borrowing limits. Sunsteel should not exhaust its borrowing limits. Some level of borrowing, some credit line should be retained for emergency use. You can easily use borrowing to meet emergency. Equity cannot be used for emergency purposes. So the company should create financial flexibility. The company should not exhaust its borrowing limits. Please remember, every company has a borrowing limit. You can't be borrowing forever or without limits. Banks will give you a credit line. Lenders will give you credit line. You can borrow up to 100 million. Or they might say you can borrow up to 500 million. That is your credit line. That anytime you want to borrow, we can give you a maximum of 500 million borrowing. As a wise business owner, you are not going to exhaust your borrowing limits. You are going to maintain certain borrowing capacity for emergency uses. Excuse me. As an alternative. Remember, you are the advisor. As an alternative, the company can use its retained earnings. Look at this. Look at the capital structure. The company has 2 billion retained earnings. As an alternative, the company can use its retained earnings to finance future expansion. It can use retained earnings first. Now, plus new debt. This is what we call pecking order financing. If you are to finance new business, start with retained earnings. If your retained earnings is not sufficient, then go and borrow more. Borrow new debt. After you are done with your debt, you can now consider issuing equity. We call it project financing, pecking order theory. Number 5, control and dividend policy. Reliable dividends are selling points for shareholders. Let me take that again. Please hold. Please 1 minute, please. Let's go on with the class. Control and dividend policy. Reliable dividends are selling points for shareholders. Let me explain that. This company pay dividends. It has a reliable dividend policy. This can be used as a selling point to issue more shares. But if you issue more shares, that can create dilution in ownership and control. Some still can issue more equity. By issuing more equity to finance the expansion, that will reduce level of gearing. However, that can create dilution in ownership and control. Alternatively, the company can take more debt so as to retain control with the current owners. Alternatively, the company can take more debt so as to retain control with the existing owners and avoid dilution. Check. The company should check the new project. With the new project earns more return than the cost of debt. Look at this point. Check. With new project earns more than the cost of debt. If the answer is yes, leverage is good. That is, when we say leverage, borrowing, gearing, you are going to ask that question as a financial advisor. The expansion project, what is the return or expected return from that project? If the expected return is higher than the cost of borrowing, then we can borrow to finance the expansion. In that case, we are going to leverage on borrowing. Point number 6. Market conditions. Interest rates in Nigeria. If it is low, debt is cheap. That is capital market condition. If the interest rate is low, then the company can borrow. That will affect the choice of capital structure. Equity market sentiment. The equity market sentiment. If the equity market is booming, look at it here. If Nigerian Exchange Group is up and booming, some still may consider issuing equity. Equity market sentiment will affect choice of capital structure. We are going to look at the equity market, the Nigerian Exchange Group. Is the market experiencing boom? If the answer is yes, we can leverage on this to issue more shares. Naira stability matters. Naira stability matters if Sun Steel imports materials. That is, we are going to consider the stability of the exchange rate. If this company imports its materials, at times, building materials are imported. If the answer is yes, then we are going to look at Naira stability, the exchange rate stability, debt in local currency is safer. If the company is to finance its expansion with debt, and the company is involved in imports, it is better to obtain Naira debt. Number 7, industry norms. We are going to compare Sun Steel with similar companies in the industry. We call it peer comparison. Sun Steel is into building materials and roofing sheets. We can compare with Dangote Cement or Lafarge, or you can compare with Nigerite. Nigerite is into building materials and roofing sheets. You are going to compare their level of leverage. Do this company use more debt or less? In other words, industry norms will affect choice of capital structure. We also look at comparison with the industry standard. Currently, Sun Steel is 45% geared. This can be compared with industry average. Number 8, covenant restrictions. I have to explain this clearly. Covenant restrictions. What this means is that the company will review current debt contract. The company will review the contracts, the existing debt contracts. Currently, debentures are secured. The company has 5 billion debentures. What are the conditions attached to these debentures? The conditions are called the covenants. We are going to review the conditions of the existing debt to check if there's any restrictions on taking more debt. Let me try to break it down. If a company borrows money, borrowing comes with conditions. These conditions are called debt covenants. Conditions attached to the loan. Some conditions can say, I'm giving you this loan today, but with this loan, you cannot borrow money again unless you repay my loan. That means there's a restriction on further borrowing. So we are going to review it. Because if there's a restriction, that means some still cannot borrow more money. We also check for small print. What is small print? We knew borrowing trigger higher interest or require more collateral. At times, existing loan might specify that if you borrow more money, that will give rise to additional interest payment to me. I gave you a loan of 100 million at 10%. And now attach a condition to it that anytime you choose to borrow money, more money, and now attach a condition to the loan that anytime you choose to take additional debt, you are going to pay me additional interest on the existing loan I gave you. The new loan can trigger higher interest payments. We are going to review this factor. If the new loan will trigger higher interest, then we better finance the business with equity. If there's a restriction on further borrowing, that means we don't have choice. We have to rely on equity. Growth prospects, growth opportunity. Where there's growth opportunities, debt finance can be used fast. Where there's opportunity that can expand your business, where there's opportunity that can expand your business, you cannot be issuing equity. Equity will take long before you can realize the money. You need to take advantage of that growth opportunity. To do that, you need to borrow money fast. Check. Return on investment or return on capital employed greater than cost of debt. If the return on your investment is more than cost of borrowing, then you can borrow to finance the investment. Lastly, regulatory and credit rating impacts. If you look at the question, the story, Sunsteel is listed on Nigerian Exchange Group. The Nigerian Exchange Group has listing rules. The rules that companies listed on the Nigerian Exchange Group. We are going to look at these rules. If any of the rules limits borrowing or equity, this company is regulated under Nigerian Exchange Group. So we are going to look at the listing rules. Is there any rule on the level of borrowing? We also look at credit rating impacts. When a company borrows more at higher level of gearing, the company's credit rating reduces. At an higher level of borrowing, that will reduce a company credit rating. If the credit rating reduces, the cost of borrowing will rise. Lenders will not be willing to borrow you money, or they will borrow you money at higher cost. These 10 factors can be considered or can be reviewed. When looking at the capital structure of Sun Steel. We are done with our question number 4. Yes, examiner may not text it, or the examiner can choose to twist the question. Right. We are done with question number 4. Let us move to question number 5. Same last diet. Main diet. Question 5. Please just 1 minute for me. I need to continue my class. Thank you. All right, let's look at question 5. Olówó PSC entirely by equity. If a company is financed entirely by equity, that means the company is an ungeared company. Look at the first paragraph. Olówó PSC is financed entirely by equity. That means Olówó is an ungeared company. And its current equilibrium market value is 65 million. That means value of an ungeared company is 65 million. With a cost of capital of 20% per annum. The next paragraph. The company proposes to repurchase 10 million naira of equity and to replace it with 12% irredeemable bond. Look at that second paragraph. It proposes to repurchase. That is, we are going to buy back equity that was 10 million naira. And you are going to replace it with debt, bond. The bond is 12%. 10 million equity. Then you're also going to replace it with 10 million debt. With this paragraph 2, the company is now introducing debt into the business. By introducing debt to the business, Olowo company will change to gear. By introducing gearing, by bringing in debt to the business, the company now becomes a geared company. Paragraph 3. Olowo PSC. Olowo's profit before interest and tax is expected to be constant for the foreseeable future. Income tax rate is 25%. That means there is taxation. There is taxation in the economy. The company has a payout ratio of 100%. Requirements A or requirements 1. Using the assumptions of Modigliani and Miller. Explain how this change in capital structure will affect the market value of the company, the cost of equity, and the cost of debt of Olowo, and the cost of capital of Olowo PSC. Examiner says, using the assumptions of Modigliani and Miller. Now the question is, what are the assumptions of Modigliani and Miller? Modigliani and Miller says, where there is taxation, the level of leverage will affect market value of the company, will affect cost of equity, will affect cost of capital. I'll repeat that. Modigliani and Miller was of the opinion that where there is taxation, A company's level of gearing, that is your capital structure, will affect market value of your company, will affect cost of equity of your company, will affect cost of capital of your company. To answer this question, you are going to adopt Modigliani and Miller with taxation. The formulas. You cannot come here. How the change will affect the following. Modig M&M with taxation. If you recall, we said weighted average cost of capital of geared is equal to weighted average cost of capital of ungeared, bracket 1 minus value of debt multiplied by tax over value of equity plus value of debt. You also recall value of a geared company is equal to value of ungeared plus debt multiplied by the tax rate. The third one, cost of equity of geared is equal to cost of equity of ungeared plus bracket cost of equity of ungeared minus cost of debt bracket value of debt over value of equity bracket 1 minus the tax rate. Now, the first requirements. Requirement A1. Market value of the company. Market value of the company. We are going to use formula 2. Value of geared is equal to value of ungeared plus dt. As a result of change in capital structure, Olowo is now a geared company. VG, value of geared. So we have to calculate value of geared by introducing bond. The company becomes a geared company. VU, value of ungeared. Return to the question. If the company is financed entirely by equity, that makes the company ungeared. The current equilibrium market value, 65 million. This 65 million represents value of ungeared. When the company is ungeared, value of ungeared, 65 million. D, value of debt, that is the bond, that is 10 million. We are going to repurchase 10 million of equity and replace it with a bond. That bond must also be 10 million. That is the assumption of Modigliani and Miller. Your letter T, that is tax rate, 25%. You can return to this formula. Value of geared is equal to value of ungeared, 65, plus value of debt, 10, multiplied by the tax rate, 25%. Value of geared is equal to 65 plus 2.5. This gives me 67.5. That is the market value of the company now, after change in capital structure. After change in capital structure. Market value. Market value of Olowo PSC is now 67.5 million. You are done with requirement A. Requirement A1, sorry. You can separate the value. This is the total market value of Olowo. It contains equity and debt. We are told that the value of debt is 10 million out of 67.5 million. Value of debt is 10. That means value of equity is 57.5. Total value of the company, total value, 67.5 million. You are done with Roma figure 1. . We are done with this. We have used the assumption of Modigliani and Miller to explain and demonstrate how this change in capital structure will affect value of the company. It has increased value of the company. Before, the value was 65 million. You can put it there. The change in capital structure has increased value of the company from 65 million to 67.5 million. By introducing debts to the business, and that was the argument of M&N, where there is taxation, value of a geared company will be higher than value of an ungeared company, because geared company will enjoy tax relief. The tax benefits will increase value of a geared company. We move to A2. Cost of equity. Now you pick that formula, cost of equity. We shall use this now. Cost of equity of geared. Cost of equity of geared is equal to cost of equity of ungeared plus, open a bracket, cost of equity of ungeared minus cost of debt, close the bracket, value of debt over value of equity, bracket 1 minus the tax rate. KEG, cost of equity of geared. That is what you are asked to calculate now. As a result of change in capital structure, by bringing in debt to the business, that is bond, Olowo is now a geared company. The company is now geared. KEU, cost of equity of ungeared. When the company is ungeared, what is the cost of equity? Let's go check. Look at it here. Olowo PSC financed entirely by equity. Its current equilibrium market value is 65 million with a cost of capital of 20%. Because the company is entirely financed by equity, that means the company is an ungeared company. Its cost of capital is also its cost of equity. The only capital the company has is equity capital. The only capital Olowo has before was just equity. So its cost of capital is also its cost of equity capital. And the company is ungeared. That 20% is the cost of equity of an ungeared. We pick that. The cost of debt, 12% to save time. I'll come in. This is 20%. KD, cost of debt. That is the debenture. Examiner say 12%. VD, value of debt, 10 million. VE, value of equity, 57.5 million. Your letter T. Letter T. The tax rate. 25%. You can calculate cost of equity of gear. KEG is equal to cost of equity of ungeared 20. You can ignore the percentage. Plus bracket 20 minus 12. Value of debt 10 over value of equity 57.5. Bracket 1 minus the tax rate 25%, 0.25. Now work this out. Apply your calculator. Cost of equity of geared is equal to 20 plus bracket 8. Work this out. 10 divided by 7.5. 0.14. 0.174. 1 minus 0.25. 0.75. Please apply your calculator. Multiply 0.75 multiplied by 0.174 multiplied by 8 plus 20. What do you have? Yes, what do you have? 21.04%. You can introduce percentage now. The cost of equity of the company now is now 21.04%. The company is now geared. Look at the comments. After change in capital structure, cost of equity increase from 20% to 21.04%. Go and look at the principle again. The cost of equity of a geared company will be higher than the cost of equity of an ungeared company. When the company is ungeared, its cost of equity is 20%. When the company introduces debt to the business and it becomes geared, its cost of equity increased to 21.04. You are done with Roma figure 2. A3. Cost of capital of Olowo. Let's take that again. Your cost of capital is your weighted average cost of capital. For this, we are going to use the formula for WACC. Weighted average cost of capital of geared is equal to WACC of ungeared, brackets 1 minus value of debt multiplied by the tax rate over value of equity plus value of debt. Close your brackets. This WACCG, weighted average cost of capital of a geared. By introducing bond to the business, Olowo PSC is now a geared company. That is what you are required to calculate. Next, weighted average. This is weighted average cost of capital of ungeared. When the company is financed by equity only, the cost of capital is 20%. Please notice somewhere, cost of equity of ungeared is the same as WACC of ungeared. You can write it down. Cost of equity of ungeared is the same as WACC of ungeared. Next, VD, value of debt, 10 million. VE, value of equity, 57.5 N. Your T, tax rate, 25%. Can apply the formula. You can apply the formula now. Please let me expand this more. I think it should be enough now. Weighted average cost of capital of geared is equal to WACC of ungeared, that is 20. This geared, 20 brackets, 1 minus value of debt, 10, multiplied by the tax rate. Value of equity, 57.5, plus value of debt, 10. Cover this. The WACC of a geared company is equal to 20 brackets 1 minus 2.5 over 67.5. Work this out. work of geared is equal to
19.26%.
20. Thank you. Final answer, 19.26%. Following change in the capital structure cost of capital of Olowo PSC reduces from 20% to 19.26. That is the impact of tax relief by financing your business with debt. You are going to have tax shield, tax benefits. The tax benefits will be used to reduce your overall cost of capital. This is the argument of Modigliani and Miller, where there is taxation. The weighted average cost of capital of a geared company is lower than the work of an ungeared company. Look at the summary. The summary will help you again. Ungeared, geared, market value 65 million, 67.5. Cost of equity 20%, 21.04%. Weighted average cost of capital 20%, 19.26. This is a summary of our computation. When Olowo is ungeared, his market value is 65 billion. When the company introduces debt and becomes geared, its market value increases to 67.5 million. This increment is coming from the tax benefits. Cost of equity. When the company is ungeared, cost of equity is 20%. As soon as the company introduced gearing, cost of equity rises. The cost of equity increase. The increase is to compensate for the financial risk. The increase in cost of equity is to compensate the shareholders for the financial risk by introducing bond. We have introduced financial risk to the business. WACC. When the company is ungeared, WACC is 20%. That is the cost of capital. Cost of capital. When the company becomes geared, its overall cost of capital reduced to 19.26. This is the benefit of tax relief. We are done with the A part of this question. Any question? Clarification? All right. Let's look at the B part of the question. Explain any witnesses of the traditional and Modigliani and Miller theories and discuss how useful they might be in the determination of appropriate capital structure for a company. This question is also clear. You are going to pick traditional theory of capital structure. What are the limitations? What is the usefulness of this theory when it comes to capital structure determination? Capital structure. Play. When you are done, you move to Modigliani and Miller. Modigliani and Miller theory. What are the limitations of this theory? What are the usefulness of this theory? If you have to determine appropriate capital structure. So, let me get your opinion. Who can explain traditional theory? Is this theory useful if you are to determine appropriate capital structure for a company? Then, what are the limitations of this theory? Any opinion?
Hello, sir.
Yes, sir, Mr. Adekunle.
Based on my own understanding on the traditional theory, I believe the theory states that a company can increase its market value and its cost of capital when it has a moderate debt in its capital structure. But the limitation is that when there is excessive debt in the capital structure, it can reduce the value of the company. And for
All
the
right.
MIM,
So let's deal with the first one. Traditional theory. Yes, Mr. Oluwatosi.
All right, sir. Okay, so traditional theory believes that there is no tax, whereas in the real world,
There's no
nothing like
tax.
no tax. No.
Right? You said the traditional theory believes that there is no taxation. That's not correct. All right. From the two contributions, it means we have not gone through the notes. If there is no other opinion, it can mean that we have not gone through the video. You know, we explained this. The traditional theory was of the opinion that there is an optimal level of capital structure for a company. There's an optimal level of gearing. This is the level of gearing that minimizes cost of capital. The theory says that company has optimal level of borrowing. That is optimal level of capital structure. To attain that optimal point is at a point where your weighted average cost of capital is at the minimum. Once your work is at minimum, you have achieved an optimal level of capital structure. At the minimum point of cost of capital, or at the minimum point of work, value of the company is maximized. Let's go to the solution. So I just want to believe we have not gone through the notes. So please, you are going to read it. You are going to read it. Whether it's going to be tested or not, we don't know. Now look at this. The traditional theory of capital structure suggests that each company has an optimal capital structure, in brackets, level of financial gearing that it should try to achieve in order to minimize its cost of capital and an efficient market to maximize its market value. Look at that. There's an optimal capital structure that you try to achieve so as to minimize your cost and maximize your value. The theory reflects what is believed by some managers, analysts, and academics to build a relationship between cost of capital and financial gearing. There's relationship between your cost of capital and your level of borrowing. Your level of borrowing is your financial gearing. It suggests a non-linear relationship between cost of equity and gearing. The theory is an inductive theory, which is not backed up by a rigorous empirical evidence. That's a limitation. If you look at M&M, we have formula to back it up. Traditional theory is not backed up by empirical evidences or model, as in Modigliani and Miller work. The theory might be useful in that it draws attention to the fact that an optimal capital structure might exist, and that financing decision might have significant impact on the company's value. That was the suggestion of the traditional school. It's relevant to your market value, your financing. You also consider tax. So please don't say he didn't talk about tax. The only thing is that there's no rigorous empirical evidence to back it up. He believes that there is tax in the economy. We now look at Modigliani and Miller theory. Modigliani and Miller theory, in a world with corporate tax, that is where there's corporate taxation, implies that the optimal capital structure will almost be 100% debt. We explain this. Modigliani and Miller said where there is taxation, companies should finance their business practicable level if you are to maximize your value. What we call optimal capital structure, that capital structure that minimizes cost and maximizes value. The proposal of capital structure. Almost entirely of debt is unlikely to be accepted. That was the position that Emma is saying, finance your business 100% with capital structure. This proposal is unlikely to be accepted by corporate financial So let me take it back from Modigliani and Miller. We are looking at the usefulness of this theory and looking at the limitation of theory. We said Modigliani and Miller theory in a world with corporate tax implies that the optimal capital structure will almost be 100% debt. But it may not be acceptable or accepted by the corporate finance. To finance our business with 100% borrowing, so as to take advantage of tax relief. This proposal by Modigliani and Miller is unlikely to be accepted by corporate financial managers. Modigliani and Miller model has been criticized for a number of reasons. This includes the assumptions of the model. Some of the assumptions are unrealistic. Some Modigliani and Miller's assumptions are not realistic. For example, individual can borrow at the same rate. As company. And this trace response at all levels of varying. This assumption is not realistic. Borrowing rates for individual cannot borrowing for interest rates cannot remain to substitute passively for. Personal loan is different from corporate loan. If still available and no transaction cost, information still available and there is no transaction cost. That assumption is unrealistic. Declining and Miller assume that there is no bankruptcy cost. So you can borrow 100%. Assumption is not realistic. If you borrow too much money, there's bankruptcy cost. At an higher level of borrowing, the life of the business may be terminated. Towards the end of the class. The network problem you were complaining about started towards the end of the class. This network problem can affect anybody. It can network that's having problem. This is a factor not within one person's control. So when you enter a class, particularly online class, some students are battling to log on due to their network. You must engage. Other limitations. The model ignores costs associated with higher borrowings. Modigliani and Miller model ignores possible costs associated with higher gearing, such as bankruptcy costs. What is bankruptcy? Where a company is forced into liquidation. Associated with high level of borrowing, agency costs, the agency costs arise because of constraints or restrictive covenants. We explain this. Covenants, the loan covenants, conditions attached to your borrowing that can create conflict between the agents between the owner of the business and the manager. Number 3, tax options. Debt finance is attractive because of tax relief. This tax relief is only available if a company has enough liability on its earnings to utilize the tax relief. You can exhaust your relief. Debt capacity. To use debt finance, companies require security. Because you require security to obtain debt finance, that limits to borrow. When there is no non-current assets that can be used to track. This was ignored by Modigliani Miller. You can go through this. All right. We shall stop here tonight. We are done with the topic. Don't forget, this topic is related to your cost of capital calculation. Capital structure, theories of gearing, cost of capital calculation. They are closely related. Most of what I explain here, you are still going to meet it. You are going to come across it when you get to your class of cost of capital computation. Any question, clarification? If there's no question, I will be checking out of the classroom. Let's have a blessed evening. And please do not accumulate your video. This video will be available within 24 hours, latest tomorrow evening. When you get your video.
Okay, sir, thank you. Please drop the lesson notes on the WhatsApp platform. Some of us are having network challenge. the notes for today so we can go through it. Thank you.
All right. Whether you ask or you don't ask, the notes will be dropped as soon as the lecture is over.
Okay, sir. Thank you.
Let's have a blessed evening.
Thank you, sir.
Thank you. Good night.
Good night.
Good
Good
night,
night,
sir.
sir.
Thank you, sir.
Appreciate